We're going to calculate the stock price for 180 degree capital. And the first step is we need the market cap, which is 51.66 million. Pretty small company. And the stock price, $1.66. So to figure out the shares outstanding, you just take the market cap divided by the stock price, and they have 31 million shares outstanding. Now we need a free cash flow, and the best way to estimate the value of a company is to calculate future free cash flow and discount that dollar amount back to today's dollars. And that's what we're going to do here. Next is net income, which is the profit or loss for a calendar year. So it makes it a little more challenging valuing a company when they report negatives. As you can see, one year they reported a negative free cash flow, another year they reported negative net income. But we'll try it anyway. Valuations are good for more stable, mature companies. Now we need to figure out the capital structure of the company, and so we can know what discount rate to apply to the future cash flows. So the income, the interest expense, they don't have interest expense. So I don't think they have any debt because they have hardly any liabilities. So we don't need the tax rate. So the cost of debt is 0 and the weighted debt. So let's figure out the cost of equity. This is going to be an easy one. 0.71 beta, that's a really good beta. That means it's very low volatility. Anything under 1 is very secure. So the capital asset pricing model calculates the cost of equity at 7.77%. And that's the cost the company needs to obtain each year to add value to its investors. So if it's not profiting at least 7.77%, it's going to lose value and eventually go bankrupt. But that's the rate we're going to use to discount the cash flows. So let's discount future cash flows. And then we have discounted cash flows. So we're discounting those dollars to today's dollar amounts. And then we have a value of the company of $63 million. And when you divide that by 31 million shares, you have a stock price of $2.03. So it is trading at a slight discount because it's trading at $1.66. And you can see historically the stock has traded around $2, $3. So my original model that I built wouldn't have been able to calculate this company because but I added a lot of extra features to try to calculate different companies, not just large companies, consistent cash flows, but also smaller companies and companies with debt. So a model is only an assumption, my assumptions. So you never know how the company will perform in the future, and that's obviously up for you to decide. But this is my analysis, and I hope you enjoyed the video. Thanks for watching.